Hey everybody, let's take a look at chapter 3 and adjusting entries. Adjusting entries are journal entries, okay, similar to what you've already been doing and learning about in chapter 2, but they are special types of journal entries. Now, to understand the why and how these journal entries are slightly different from what we've been looking at, we have to understand or kind of revisit the notion that accounting is the process of recording our finances for the business, right? But we're also slicing our business up into increments of time. Okay, so operationally, when you go from September 30th to October 1st, or from October 31st to November 1st, or from November 30th into December 1st, operationally, it's one day to the next, and it doesn't seem, there's nothing really different in terms of customers are still coming at your store, you're still trying to sell to them, and so on. But from an accounting perspective, we have this cutoff, and it's a necessary cutoff to kind of enable us to, in monthly increments, show the outside world and to ourselves for internal purposes, the finances of our company. So what we want to have is at the end of each month, we want to have a very clean and clear understanding of our finances, which means that at the end of each month, we're going to have a kind of wrapping up of all the activity for that month so that we can show an income statement for the month of November, or a balance sheet as of November 30th, and so on. Now, in order to show those financial statements, we have to make sure that we properly match or capture all of our revenues and expenses for that month. And that's called the matching principle, okay, where we match our revenues and our expenses. Now, think about pizza boxes. Think about a pizzeria. And we have pizza boxes are a supply that a pizzeria will use in order to put the pizza into some kind of a box that they can then deliver to the customer. That is a supply that's going to be used up over time. So the pizzeria owner is going to want to be able to show at the end of the month how many pizza boxes they used to get pizzas into the hands of their customers. So if the pizzeria owner sold, let's say $1,500 worth of pizzas, the pizzeria owner is going to want to be able to capture how many boxes did I use in order to sell those pizzas. If the pizzeria owner is not capturing that expense, then there's potential that they're undercounting expenses, and therefore there will be a mismatch in terms of revenue and expense, which will distort the profit, okay, the pizzeria's understanding of profit. If you don't have an understanding of profit, you're at risk of potentially working at a loss without even realizing it. So this idea of matching principle is matching expenses with the assets that we're using up. Okay, or with the revenues that we're selling. So the supplies expense is an example of an adjusting entry. Another type of adjusting entry is going to be called depreciation expense. And this is where we have some piece of equipment, maybe it's a vehicle. In Natalie's case, with Cookie's Creations, we're going to see it's a mixer. It's a high-end mixer what she uses to like mix her dough. And with an asset like that, we're going to see the gradual wear and tear of that asset being used up. That gradual wear and tear is called depreciation expense. Now, I have here on the example, equipment could be a treadmill at a gym, okay? Imagine a brand new treadmill that's just been unpacked. You're a customer at a gym, you step on it for the first time, it's gonna be shiny, it's gonna be new, it'll work really, really well. It's no dings or dents or anything like that. At the end of maybe 5 years, however, that treadmill is going to look very different. It's going to be maybe scratched, marred up. It's not going to look the same. It might not act the same. And that's because it has slowly eroded over time, and it's basically depreciated. Its value has gone down. I have a separate video about depreciation, so I'm going to put a pause on this one, but just know that depreciation is also not recorded during the month. It's something that we must record at the end of the month, and we do that in order to capture a small slice of expense of an asset like a mixer, like a treadmill, being used up, okay? So we'll focus on that in a separate video. Some items are unrecorded because we have no reason to record it until the end of the month. And a good example of this is utility bill. Again, we'll see this with Natalie. Utility bill is kind of like your phone bill, your cell phone bill. You're not recording in your accounting records day by day that you're using up your lights each day. Instead, what you do is you take the bill from the utility company and you record that full month's worth of utilities usage all in one journal entry called the adjusting entry at the end of the month, okay? That'll be utilities expense going up, and then you'll either pay it with cash or it'll be an account payable. Again, we'll see an example of this with Natalie and Cookie's Creations. So as you get into the cookies creation case study, just know that we have 5 transactions. Each of them looks at an adjusting entry. So we'll get some hands-on experience with this. What we've already done is we've journaled throughout the month, we posted to the ledger throughout the month, and we've created an initial trial balance. Now we're creating some additional adjusting entries at the end of the month. We're also posting those to the ledger, and then we're going to update our trial balance. We're going to have what's called an adjusted trial balance. It's going to act very similar to the trial balance that we created initially, otherwise called the unadjusted trial balance. Once we're done with the adjusted trial balance, we'll be able to finally complete our financial statements. Okay, and we'll look more at that in chapter 4. And we'll also have some hands-on learning experience in class with cookies creations. Okay, I'll see you in class. Thanks.